How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to do an episode. I just wanted to kind of pay my respects to two legends who recently passed away. That is Dr. Daniel Kahneman and Jim Simons. These two men are, just kind of titans of the financial world. And it's a shame that we just lost the two of them recently. For those that didn't know, I believe it was just on, I think it was May 10th. Jim Simons passed away at the age of 87. And Jim, for those that don't know, is basically, this book was famously written about him a few years ago. This was called The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. So, we'll get in here. There was a couple of Wall Street Journal articles that I wanted to share with everybody. We'll come back to Dr. Kahneman here in a second. So Jim Simons, a pioneer of quantitative trading, dies at age 87. He was a mathematician. He helped usher in a revolution in trading, embracing a computer-oriented quantitative style in the 1980s. I can remember studying Jim Simons, a mathematician who became one of the most successful investors in modern financial history. He was a cutting-edge code breaker and a geometer. Simons helped pioneer a revolution in trading, embracing a computer-oriented quantitative style in the 1980s, well ahead of the Wall Street crowd. He and his team employed trading algorithms and artificial intelligence to outperform the market, and the likes of Warren Buffett, George Soros. Later, Simons became a political donor and an influential philanthropist in the worlds of science, health, and education. Simons was the son of a Boston shoe factory executive, developed an early passion for mathematics, and ignored the advice of the family physician who urged him to steer clear of the field because he couldn't make a living. The warning proved misplaced. Simons began his career as a professor at the Massachusetts Institute of Technology, MIT, and at Harvard. He proved popular with students. One year, Simons amused a graduate class by confessing that he didn't know much about the topic, partial differential equations, but that he viewed teaching the course as a good way to learn. Simons became restless, though, and he started businesses with friends and dabbled in trading. Friends and family detected a desire for wealth. So Jim understood at an early age that money is power, said Barbara Simons, his first wife. During the Cold War in 1964, Simons joined a U.S. intelligence organization fighting the Soviet Union. He successfully broke Russian code, but was fired when he took a public stance against the Vietnam War, upsetting his boss, who had spoken in favor of the war. Simons joined Stony Brook University in Long Island, New York, where he ran the math department, developing an ability to recruit talented professors. At 37, he won geometry's highest honor, cementing his reputation in the world of mathematics. His Chern-Simons theory remains one of the most widely cited math papers of the past century. And then he says farewell to academia. So in 1978, at the age of 40, Simons astonished his colleagues by quitting academia to try his hand at trading. He started an investment firm in a dreary Long Island strip mall next to a women's clothing boutique and 2 doors from a pizza joint. At the same time, many rivals were fundamental investors. If you know the all-time Wall Street classic, Fundamental Analysis, written by Benjamin Graham. And that is basically, Benjamin Graham was Warren Buffett's teacher. Kind of went Benjamin Graham, Warren Buffett, and then on to many people thereafter. At the time, many rivals were except fundamental investors, chatting with corporate managers, scrutinizing balance sheets, and relying on judgment and intuition to predict the ups and downs of investments. So where others saw the zigs and zags as chaos, Simons, who had been trained to scrutinize large data sets, sensed that financial markets had more structure than most presumed. So I developed a view that markets are not random and were to some extent predictable. He later said in an interview with the Wall Street Journal, there were statistical anomalies that could be exploited. So early on, Simons traded like most others, reading the news and betting on gold prices and other investments. He scored gains, but found it hard to endure the market's volatility. He developed stomach pains and berated himself for miscues. One day you're a genius, the next you feel like a dope, said. So fundamental trading gave me ulcers. So Simons set out to build an automated trading system that could discover fleeting and overlooked patterns in prices. I want models that will make money while I sleep, Simons told a friend at the time, a pure system without humans interfering. And then down here it says a payoff finally. By 1990, Simons and his team in their Eastern Connecticut, New York headquarters had identified ways to profit from currency, commodity, and other markets using short-term patterns they had found. It took years longer, but the firm, by then called Renaissance Technologies, eventually discovered a way to make billions of dollars on stock. So their winning strategy, holding investments for short periods, even minutes, turning almost all of the trading decisions to computers and maintaining a veil of secrecy unlike almost any in Wall Street's history. Colleagues said one reason for the firm's success was Simons' ability to coax accomplished mathematicians and scientists to join his firm and get them to work together. His genius was managing genius. So, and he basically said he had many converts today. More investors have embraced Simons' mathematical, computer-oriented approach. About 1/3 of all money is managed by so-called quant firms, and businesses in various industries rely on algorithms. So, again, Mr. Simons became obviously a absolutely towering figure in the world of finance and in the markets. And so I highly suggest if you have never had a chance to read his book, again, I'll put it up here. It's called, this is written by Gregory Zuckerman. And Gregory also wrote a book called The Greatest Trade Ever, which was about John Paulson's $4 billion winning bet against the collapse of the real estate market in 07, 08, 09. That is an absolutely fantastic book. If you never had a chance to read that, go check it out. But again, this is called The Man Who Solved the Market, How Jim Simons Launched the Quant Revolution. And if you haven't had a chance to check that out, definitely give it a read. It is a fascinating read. Okay, let's go to our next here. So, the psychologist who turned the investing world on its head. So Daniel Kahneman gave people an understanding of what drives financial decisions. So Daniel Kahneman explained investors to themselves. A psychologist at Princeton University and winner of the Nobel Prize in Economics, Kahneman died on March 27th at the age of 90. Before the pioneering work done by Kahneman and his research partner, Amos Tversky, who died in 1996, economists had assumed that people were rational, meaning we are self-interested, use all available information to make unbiased decisions, and our preferences are consistent. This also kind of gets back to what they call the rational markets theory, that markets will always kind of find a rational equilibrium. I have never really espoused to the rational markets theory. I mean, I believe that markets run on emotions, they run on fear and greed, and when those two things are kind of low, that's when the market will kind of find its equilibrium. But I digress from here. So, Kahneman and Tversky showed that's nonsense. Their findings directly or indirectly inspired change across the business world, including the redesign of organ donation programs and improvements in planning for multi-billion-dollar infrastructure projects. Kahneman was a pioneer of what became known as behavioral economics, although he always saw himself as a psychologist. Investors who take Kahneman and Tversky's lessons to heart can minimize fees, losses, and regrets. Kahneman may well have had more influence on investing than anyone else who wasn't a professional investor. I believe that is probably true. So then it kind of gets into the mystery of financial behavior. Why do we sell our winners too soon and hang on to our losers too long? Why don't we realize that most hot streaks are just luck? Why do we say we have a high tolerance for risk and then suffer the torments of the damned when the markets fall? Why do we ignore the odds when we know they're stacked against us? Danny placed softly back and forth at the front of the room, sparkling with amusement as he documented these behaviors and demolished conventional economic theory. For decades, he and Tversky had conducted experiments almost childlike in their simplicity to see how people really think and behave. And And then it kind of goes on to say, like, no, people don't incorporate all available information. We think short streaks in a random process enable us to predict what comes next. We think jackpots happen more often than they do, making us overconfident. We think disasters are more common than they are, making us suckers for schemes that purport to protect us. Ask people if they want to take a risk with an 80% chance of success, and most say yes. Ask instead if they'd incur the same risk with a 20% chance of failure, and many say no. It's the same thing. Noting that the stocks people sell outperform the ones they buy, Danny joked that the cost of having an idea is 4%. So Daniel Kahneman was a very, very amazing guy. He became kind of the godfather of behavioral finance, behavioral economics. His book right here, the winner of the Nobel Prize in Economics, was Thinking Fast and Slow. This was basically his I mean, he wrote other books, but I think this will probably be the one over the years that he'll be the most well known for. Again, absolutely fantastic read. If anyone has not read that, I highly recommend it. You add that to your collection. And so again, these guys were both just titans of the financial world, and they both lived very long, rich lives, and did some pretty incredible things along the way. And I have tremendous respect for both of these gentlemen, and I just think that we should, like I said, I think it's good to talk about them and their accomplishments and what they did, because they both, whether people realize it or not, I mean, these two gentlemen, they changed your life. Jim Simons and all his work in basically quantitative trading, and bringing in what they called the quants into the market, basically, completely changing things. So up until the 90s, when he started doing, basically creating algorithms and doing quantitative trading, again, markets you either, you used either fundamental analysis, which they mentioned, or you used what's called technical analysis, basically the studying of stock charts and a more visual representation of how stocks and the market is moving, based on all kinds of economic indicators, and graphed and charted, and and then looking at various different tools related to a stock. Its volume, it's and then you're looking for resistance and various other cues in there that I could spend hours going into. But again, he kind of, and then I think you had a lot of people that basically took his quantitative trading and said, okay, I like fundamental analysis, or I like technical analysis, and I'm going to kind of incorporate that into our kind of trading style, or our trading programs, or how we're going to do certain things in the market. So you have kind of all kinds of variations today on a lot of these different philosophies and techniques in the finance world when it comes to trading, and how retail traders do things, how professional traders do things. But then, Daniel Kahneman, looking at behavioral finance, why do we do some of the things that we do? Again, why do we hang on to losing trades longer than we should? Why do we sell the winners quicker than we should? Why do we do kind of all these oddball things, and what really drives us to what's really at the crux of the matter, and what really drives us to do these things? So again, hope you'll check these books out someday. And like I said, hope you'll do a little research on these two gentlemen, because they were amazing. They were amazing guys, amazing contributions to the world of finance. And, they're a rare breed. I mean, I'm sure we will have many more people in this world that will come and do amazing things and kind of change our lives. But these were just two guys that basically I kind of, grew up with. I mean, I can remember reading about, Jim Simons and what he was doing in college. I can remember reading about Daniel Kahneman and what, him and Tversky were doing when I was in college. So, these are just people that had, have had in my, 25-year banking career. I mean, these two guys had, tremendous impact, on the world of finance, throughout, my, basically my entire life, my entire career. These guys were kind of always there, kind of always busy doing stuff. So that's what I said. So I felt like I wanted to do an episode here where I could kind of talk about these two a little bit and hopefully just, honor them a little bit in my own unique little way here. So, but just to wrap up, so if you like this episode, please make sure to like, share, and subscribe. You could check the channel out on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below, and I will be back to see everybody again real soon. Thanks a lot.